PepsiCo stock is down by 26.9% from its peak in May 2023. It is actually one of the biggest drops in the history of this company. So, is it cheap? Is it a bargain? Or maybe even after this correction, it is still overpriced? Or maybe there is a problem with the company itself? Well, today we are going to go through our 7-step analysis process to find out. But first, let's take a look at the recent financial results of PepsiCo. There is almost no change in revenue year over year. Net income is up by 5.5%. Cash is down by 12.4%, and debt is down by 1%. So such results are okay. We don't see any meaningful changes here. And this 12% reduction of cash represents around $1.2 billion. And that is what PepsiCo spent to buy Siete Foods, which makes gluten-free tortillas, snacks, salsas, and other healthier food options. Yes, I know it is hard to believe, but supposedly there are healthier things than a combo pack of Lay's, Doritos, and Pepsi. Okay, let's take a look at this Dividend King. If you invested $1,000 in this company 10 years ago, you bought 10 shares. And today, they would be worth something close to $1,495. And this company also pays dividends. So in that time, you would get $407 as dividends. So if we add together the current value of shares and the dividends, we get $1,902. And that is a gain of 90% in 10 years. It's not a bad result. We would almost double our money, and PepsiCo is definitely not a very risky company. So if you are trying to preserve and slowly grow your wealth, it could be a wise choice. But if you are looking for a company that will double your money every 2 years, then this may not be a perfect fit. Okay, let's see who believes in PepsiCo. Individual insiders, that is an X, 0.1% of the company is owned by individual insiders, and we would like to see this number over 2%. So unfortunately, the management does not have its skin in the game. And are individual insiders buying? That is an X. We actually saw a number of sale transactions last year. And do super investors own this company? That is a check with 9 super investors, including Terry Smith, David Katz, and Thomas Geithner. And are super investors buying right now? That is an X. David Katz bought almost 33,000 shares, but other investors sold over 390,000 shares. And with the price going down all the time, I wonder when this trend is going to change. Okay, let's take a look at some fundamentals. Return on invested capital, that is a check at 14.4% 10-year median returns. And we want to see this number higher than 10%, so that's okay. And what do we know about net profit margin? It is a check averaging 10.1% over 5 years, and the industry median is 8.3%. And now let's take a look at share buyback. It is another check. They bought back 10% of shares in the last 10 years. So that is very good news for shareholders. And the debt, it is an X. It would take PepsiCo almost 5 years to pay the long-term debt with a current free cash flow. And we want to see it under 2 years. So debt is substantial, and it's definitely something we shouldn't ignore when thinking about PepsiCo. Okay, so we know some of the most important numbers when it comes to financial health. And now, let's take a look at growth. Revenue growth, that is an X at 3.3% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so that is not great. Free cash flow growth, that is another X at minus 0.3% in the last 10 years, so even worse. And earnings per share growth, that is an X at 5% in the last 10 years. The share buybacks definitely helped here a lot. If there are less shares, then of course earnings per share are higher. But there is another way to create value for shareholders besides buybacks. Dividend yield is 3.7%, so shareholders can expect to get $5.33 annually per every share. That is a nice yield. And the payout ratio, that is an X at 65.6%. And we want to see the payout ratio somewhere between 20 and 50%. So it's a bit too high, but nothing we should really worry about. They still have a lot of cash to grow the business, pay back debt, which probably would be a wise thing to do, or acquire other businesses. And what about dividend growth? It is a check at 7% 5-year growth rate. And the best thing is that they are growing this dividend every year for the last 52 years. That means that they are a dividend king. And we can expect the dividend to continue its growth in the coming years. Of course, anything is possible, but further growth is very probable. Okay, so we know quite a lot about PepsiCo already, but let's value it and see, is it a good investment opportunity at a current time? Usually we use a discounted cash flow analysis to value companies, but I wanted to try a bit of a different approach, especially that it is a dividend king, and we can define value in such a company in different ways. Firstly, we will value PepsiCo just like any other business, but then we will use our valuation calculator to estimate its value using other methods. Okay, so now we have to predict the growth of PepsiCo for the next 10 years, and we will make 3 scenarios: low, medium, and a high one. So in the low scenario, we will estimate a growth of 4% for the first 5 years, and then 3%, in the medium 6%, and then 5%, and in the high scenario 8% and then 6% growth. So the low scenario is close to the growth we saw in the last decade. Medium is showing a story in which PepsiCo will slightly accelerate this growth, and the high one is closer to the predicted growth of the industry, which is around 8%. So with such estimates, the intrinsic value in the low scenario is $57, in the medium $69, and in the high scenario $80. And after applying a 30% margin of safety, we get in the low scenario $40, in the medium $48, and in the high one $56. And the current price is around $143. So it looks like PepsiCo is very expensive. But now let's take a look at some other valuation models. So let's open our valuation calculator. Here is the DCF model we just used. Now, next step is comparable company analysis. And if we compare PepsiCo value to Coca-Cola, Monster, Dr. Pepper, and Mondelez International, we get an estimated valuation of over $160. So in comparison to other companies in the sector, PepsiCo does not look that expensive. But when we look at PEGI ratio, it is actually quite high. When the ratio is below 1, that means that the stock is undervalued, but it is well over 2, so rather expensive. And finally, let's take a look at dividend discount model valuation. And that can be very interesting since it is a dividend king. So if we concentrate on the dividends, the price is $141. So basically, that would mean that PepsiCo is fairly valued right now. So we get many different ways of calculating company's value, and the prices are all different. But we don't need a precise number. We need a range in which we can say that a company is fairly valued. So let's go to the final tab that will put all of the results together. And we see that the intrinsic value is around $100. So when we combine all those models, it still looks rather expensive. And if you would like to learn more about all those valuation models, head over to stockinvesting.academy and see our company valuation course. Okay, let's take a bird's eye view of this company. So on one hand, we have a dividend king that is a very stable company. On the other hand, we have low growth, a lot of debt, and also a pretty high price. And that is even after the recent drop. So now let's go to our Stock Ranking Pro, and firstly, let's filter it to only see companies in the beverage industry. So we have here Anheuser-Busch, Coca-Cola, Monster, and PepsiCo. And when we look at the value difference between the intrinsic value and the current price, we see that they are all pretty similar. PepsiCo seems to be the most expensive one, but not by a huge margin. And if we were to treat it as a long-term investment or even buy and forget kind of stock, we should look at what can we expect when it comes to creating shareholder value. So let's look at share buybacks. And PepsiCo bought back the most shares in the last 10 years. That is very good. And the other way we can get our money back is through dividends. PepsiCo has the best dividend yield, similar payout ratio to Coca-Cola, and the best dividend growth. So if you want to concentrate on dividends and hold stocks for many, many years, it may be a solid addition to your portfolio. But if you are looking for growth, then PepsiCo, even with all the acquisitions it is making recently, will probably not be a right pick for you.